Going on?
You do it.
Yeah, it adds a human
Can you
touch if you,
can you guys hear me? Can you guys hear me?
Oh,
Okay.
we can hear you.
Yeah.
yeah.
Okay. I'm just chilling.
There you are. How are you?
I'm good. I tried to dial in 3 times, but I'm in on the phone, so we're
I'm
all
glad.
good.
I'm glad
I
you
heard
figured.
bourbon. You had me at bourbon.
Yeah, we talked about bourbon a little bit on the last rundown. We have
Man,
a 12 days of TM, or we have 12 days of cocktails in my house where my husband makes all sorts of fun bourbon and a few other drinks.
love
For
it.
us. So we chatted about that the last rundown. But this week is because I have a bet going right now with David Kittle, who's our CEO and one of our founders. And it is Clemson is right now literally playing Kentucky. And uh, if we don't make the wait, if I don't know how to bet these things, but apparently he betted the Vegas line, and my husband tells me that means we have to win by 4 in order for me to win today. So we just scored like before everybody got on, and we're literally up by 4 points at this point. So I'm very excited. Last few minutes of the game, and if I
Love
lose,
it.
I owe David Kittle a bottle of bourbon. So
Oh, sounds
back to
sounds
the
like a
bourbon.
no lose situation.
Yeah, yeah. Well, pretty much.
Boy, it's not. I think the people who tune in, Melissa, are pleased to see the non-business human side of you. That you actually have a sports gambling addiction, and I
I
think a lot of folks who tune in can sympathize.
I do not. I only ever, and those of you that know me know, I will only ever bet on a bowl game. And for those of you that like have your phones up, please do not put anything in the chat about the score. I really want to watch the last few minutes of the game, and I'm very much a huge Clemson fan. So if you hear a giant explosion in the background of people screaming, it is my family. They're downstairs watching the game. So it could be positive or negative. We won't know, but I'm going to apologize out of the gate.
All right.
All right, we can go ahead
Well,
and talk about mortgages a little bit. Is that okay?
I want to, like, Kevin, are you in Colorado or something, or what's
I
with
I
these?
I I threw on the shearling, just because it looks like you're in a cold spot. It looks kind of dreary outside. Not as dreary as the cemetery you were at the last time we were on a call together, outside of Memphis. But I felt like you guys are probably a little chilly, and I instead of rubbing it in on a t-shirt, I would just kind of be it's like getting sympathy weight when your wife gets pregnant. You just gain weight with her. That's where I am. I'm for the home team.
Okay, so you put on a jacket to make us feel better that it's probably
Yeah,
70 degrees and sunny where you're at.
it's it's not bad.
Okay. All right. I am a
All
little
right.
jealous, I'll say. All right.
I'm
Well,
Kevin. I'm actually um yeah, I was telling Melissa that I had a good background all set up, and then here in the Bay Area it started to rain about 20 minutes ago. So I'm
Oh,
stuck in the car. I'm not I know Audrey Boysono is on here. I've done a show with Audrey. I told everybody I was in the back of a patrol car, having been detained for trespassing. But no, this is just my 88 Toyota Corolla interior here.
well,
So
I almost joined you in the car because we have 4 kids, and I thought they were gonna like be shuffled out of the house, but they just went in the other room, and they keep coming down here and peeking around the corner. So I may get bombarded, but I did read up. I read up on your hypermobility on your shoulder, and I think you would be able to wiggle out of some handcuffs.
oh man. Yeah, did you watch that clip?
I didn't watch the clip, but I read your resume about the hypermobility, and I actually feel you because I have an acromio clavicular issue, also known as the AC joint. So yeah, loose shoulders, man. It's a tough gig. There's always something you got to deal with.
learn something new every day.
Yikes. Football, anatomy, maybe at some point we will get to mortgages.
Yes. And we did talk about bourbon a little bit. So we're hitting all the fun, important things of not mortgage.
All right.
All right, let's go ahead and get kicked off. Welcome everybody. I'm Melissa
Kicked
Langfeld.
off.
was
And
good.
always joined by Rob Chrisman. Today we have a very special guest with Kevin, the Chief Lending Officer at PRMG. KP, thanks for joining us. Appreciate
Thank
you
you.
at least being present and having some sympathy jacket on for us.
For a few minutes at least. It'll get hot.
For a few minutes. It might get too warm there. You can take it off. If we start to see your face go red, and you're welcome to take it off. Okay. Let's go ahead and talk about mortgages a little bit. We obviously have, today's like the last working day of the year. We've had an interesting year in mortgage for a lot of our mortgage friends, and we've had an interesting kind of week with some of the cybersecurity incidents that have happened with our friends at First American, and there's a lot here that we can chat about. So let's kind of start with cybersecurity, since I kind of landed on that spot. Obviously over the last week, there's been a lot of talk around First American. They were not the first one to have this incident. They won't be the last by any stretch of the means. This is something that's kind of prevalent in the industry right now, particularly with how much our industry deals with non-public information. And so I'll kind of start us off with, KP, in your space, like what is an impacts of something like this, happen to you, either your company or your peers that you're talking to in the industry? And then, what are some of the big things that you feel like we need to be aware of going into the future to help prepare?
I'm sure at PRMG, many of the TMC lenders and anyone else out there running a small business, cybersecurity, security of personally identifiable information, PII, depending on which state you deal with, it's just gets more and more important, and we keep seeing more regulation around that. And it's one of those things, like if you're a pure production person, which is where I started my career, and then now, now as a shareholder and an owner of a lender, you're like, man, this stuff really matters. And then when this happens, then your team and your cybersecurity team, your IT team, your CIO, CTO, whatever, they're like, see, I told you so, And we all have our cybersecurity policies that we have to renew every year. They seem to be getting more and more expensive. We do penetration tests. We have RSM McGladrey come in and do a test. Basically, they tell us like outside LOs and their hard drives is the most exposure that you have, especially if you hire a group in a retail channel and they come in with their own equipment that you didn't secure. With some kind of software to turn it into a brick on a dime if you have to. So you start to look at all these things, and it matters because, you mentioned our good friends at First American, great company. They just paid $1 million fine to the state of New York for a 2019 incident. And then boom, this happened like right when they're paying this fine. And it sucks because there's still reverberations of their systems, which they have a lot of systems throughout the industry. They have their arms and tentacles on a lot of stuff, and you don't really notice it until this kind of stuff goes down. So it's obviously I know I'm probably not saying anything important when I say it's or meaningful when I say it's uber important. But what do you do? Do you do penetration tests? Do you show your regulators, states and federal, that you're taking this seriously? Do you have a cybersecurity policy? Do you actually make your originators change up their tech stack? There's all kinds of stuff like that. Oh, hi, Serafina. She doesn't have to worry about cybersecurity. Oh, my 4-year-old. But so yeah, I mean, you have to make some hard decisions and tell your retail people and distributor retail, like we gotta make sure that your computers are secure. That's why we make you use the laptops that we sell or use the software and have an admin. That's why you can't have all these outside systems doing other stuff. I mean, think about texting. Like, we're not quite there yet, but like everyone just texts realtors and borrowers all the time. Like, banks got it right. Like you can't really do this stuff unless they have oversight on your texting, on your personal cell phone. And so we're going to see more of that line moving over into what we thought was our personal space, kind of being encumbered by the business, because the business is going to pay a ton of money and have a lot of fines for this stuff.
Yeah, well, and John put it in the chat here. I mean, this has a really significant impact on customers. as well. I mean, there's people that, aren't closing on their homes or, not able to move. There's cost of movers involved and, all of those sort of things that, we can all imagine. But it also, there's arms and legs to this, right? As you mentioned, there's appraisers that are impacted. There's, it's really impactful. So taking the right measures up front is really, really important to companies, even though it's not something you necessarily want to have to think about every day as you're, trying to run your company. It's integral.
Yeah, David Gibbs just put a comment there about the attack on Mr. Cooper. That was done by like one of these little nefarious dark web hacking groups. Literally a hacking group took credit for hacking Mr. Cooper. Think about that. Our industry is on the radar, and I don't want to say anything mean about them because I don't want my company targeted, but these awesome, incredible groups that make us stronger by attacking us. But seriously, like this, like dark web group, like attacked Mr. Cooper and all their servicing platform. I mean, and there's some really smart people out there who are going to find a way to hack these systems that we've been using for like 20 years. Like, think of the software that's out there. It's not exactly, state of the art, right? And so, our industry is going to have to step their game up.
Well, and even, I mean, that's like a very direct example where people are hacking directly into a system. There's also people that use kind of, dark web, personal information for customers, put it through POS platforms and try to see if the social security numbers they bought are real or the date of births that they bought are real, right? So there's kind of, even if they're not trying to get into your company, having every aspect of it secure enough to be able to eliminate things like that are also really, really important.
It's almost like painting the Golden Gate Bridge. Painting the Golden Gate Bridge, they start at the south end, then they go to the north end. By the time they get to the north end, they go back and start painting the south end all over again. I mean, it's just a continual thing. When you talk about testing, Kevin, it's almost as if you have a cybersecurity group or your IT group or whatever. They run all these tests and test and test throughout time, test, and then it's like time to start over again, right? I mean, they're just always testing something.
Well, the evolution
and it's vendor and it's vendor management too.
Yeah.
Right. So all of our vendors, we got to make sure that they're secure. Like, do they have SOC certification, or do they have, certain measures to make sure that, they're also secure if they're going to be tapped into our systems. And that's not even if they're tapped into like personally identifiable information, right? Like, is a cell phone number PII? I mean, we deem that it is because it's not readily available in the public space. And so if you're dealing with a cell phone number and you're a vendor that's helping you market, sales up funnel activity, I got to make sure that vendor, is secure as well. I think, is it 7 years, right, to paint the Golden Gate Bridge, 7 years, and they start over? I think that's the number.
Boy, you stumped the chump as usual.
I think it's 7 years. And on that note, I saw this fascinating TikTok video like 2 weeks ago on how they built the Golden Gate Bridge. It's unbelievable, the process. Like 100+ years ago, like the brains they had to build that thing. You're like, wow, they were like that was 100 years ago. And the engineering feat is amazing.
The 1930s. So
it's pretty amazing.
Yeah, 1930s when in fact, my dad, they opened it up, and my dad the first day walked across it. So.
Oh, that's amazing.
Very cool.
So 1930s. Anyway, yeah, I'm sure somebody like Ira Selwyn will figure out how to do a Google search on how long it takes to paint the Golden Gate Bridge. Anyway,
Ira's a smart dude. You gave him a shout out the other day. Yeah, you gave him a shout out the other day. He's a smart dude. Ira's a good dude.
Yeah. He's a very smart good dude. Okay. All right. Let's talk about kind of 2024. Obviously, we have a ton in store for us in 2024. We've had a lot of predictions, come out.
4 years, Ira says.
Oh, Ira says 4 years. We knew it. He would be the one to find it. Thank you, Ira.
The technology has gotten better. It used to be 7, now it's 4. That's my disclaimer. Okay.
Maybe they just got more people on it. I don't know.
Yeah. Your tax money. Thanks, Rob. Thanks for paying taxes.
All right. So Fannie, Freddie, obviously NAHB's come out over the last week with lots of predictions around 2024. I'd love to hear, KP, you talked about this a little bit in your last video, but I'd love to kind of have you share a little bit of what you think is in store maybe in the future, and Rob, you as well.
Well, I'll be brief and let Rob get some time in here. But our business is so simple, right? Rates go up, business goes down. Rates go down, business goes up. And rates have gone down pretty significantly. And there's still some volatility out there, and some uncertainty. So there's a spread between the 10-year Treasury and, the 30-year fixed rate mortgage. But man, it's come down quite a bit. And I read some Black Knight data that when rates went from 7 to 8%, 5 million borrowers were priced out of the market. Well, now they're priced back in. And so, now 5 million borrowers, right? I mean, we're going to sell less than 5 million units in a year. So demand, again, outweighs supply. And when the Fed actually cuts rates, which if I were to put a gun to my head, I'm thinking the May meeting, 50 basis points. That's my guess. I think they for sure skip in January. And it's kind of like they can't go in March because it's too soon, right? So, they could, but I still think they wait. And that'll open up the floodgates for the back half of the year. We'll get some refi business. We're already seeing a lot of VA and FHA streamline churning business going on. I think it'll be an upside surprise. So I think we could have a $2 trillion a year. And that's a big, bullish, no one said that number yet bet. But I wouldn't underestimate the power of how much you can save, even if you just get half a point better break on your note rate when these loan amounts are so much bigger. I mean, the high balance number is like $1.15 million for an A paper high balance rate. It's crazy. So don't fight the Fed.
All right, Rob, do you agree?
Well, yeah. I wish I had something to add.
You can tell me my $2 trillion number is too bullish.
Somebody actually I think somebody needs to check on IRA. It might be 3 years IRA instead of 4 years for painting the Golden Gate Bridge. Yeah, you can't fight the Fed. The Fed has been, the problem with the Federal Reserve, it's kind of like if you are the CEO of Fannie Mae or Freddie Mac, you have the FHA looking over your shoulder. You have the U.S. government looking over your shoulder. You have millions of borrowers looking over your shoulder, thousands of lenders looking over. I mean, everybody's second guessing what you do all the time. If you're Jerome Powell, who'd want that job, really? Because, or basically any Federal Reserve district president, it's a very, very difficult job. So we can talk about the Federal Reserve. I think the Fed, yeah, they probably overreacted, but it's a very difficult job. And people have to remember that the Federal Reserve is in a tough spot. They are, they can do everything right, and then some ship gets stuck in the Suez Canal, or the Red Sea shipping goes to hell in a handbasket, and so inflation goes up, despite the Federal Reserve's best interest or best intent. I think inflation has been coming down. I think the economy is doing, Melissa, I sound like a broken record. The economy is doing okay. And yeah, you can torture the data until you find something about something that you say, well, the economy isn't doing so great, Rob. Look at this component. But you know what? Employment is solid. There's housing price appreciation. Inflation is coming down. Sure, not everything's going gangbusters, but we don't want everything going gangbusters. We certainly don't need housing prices going up 20% a year. So I think things are going okay right now. And if things are going okay, to Kevin's point, you don't want to fight the Fed. The Federal Reserve has been fairly consistent in its pronouncements about, we have a target rate, 2%. Are we ever going to get back down to 2%? Maybe. It's been heading in the right direction. And I think the market appreciates that. And to a great degree, the bond market has been doing the work of the Federal Reserve because I think maybe interest rates, in the open market got a little bit ahead of themselves. And so now they've come back. Treasury rates have come down, mortgage rates have come down, and maybe we just sit here for 3 or 4 months. What if rates just sit here for 3 or 4 months? Is that such a bad thing? Probably not. Um, and so let's figure out, where we go from here. It's not, Kevin, I mean, you can disagree. Actually, you and I think, agree on a lot of things. I will say that, the companies out there and the loan officers out there don't base their livelihood and their business model on somebody else's interest rate predictions. You can't. It's kind of like the weather. Like today, like I said earlier, I had this cool backdrop and then it rained. Well, so now I'm in my car. It's not like I'm not going to join the show because I've got to do the show from the car. We just adapt. And so companies and individuals, originators figure out, okay, well, the interest rates are going to do what they're going to do, but how are we going to react? What kind of programs are we going to offer? What kind of down payment assistance are we going to offer? How are we going to help our originators do what they do best? What kind of software do we need, and so on. So in order, when you talk about looking ahead to 2024, we've seen a tremendous amount of interest rate volatility in 2023. Probably we won't see that again in 2024. But if we do, we're still going to keep lending. People need our help. It's a good business. It continues to be a good business. So we just kind of, yeah, interest rates are going to do what they're going to do. The Federal Reserve is going to do what's going to do. Here's how we're going to get more market share. Here's a new program we're rolling out. Here's how we're going to make our originators' jobs easier. So that's where I'm seeing people focused as we wrap up 2023.
Yeah.
Yeah, you always. Oh, did I lose? Hey, babe, can you open that door?
Did we lose Kevin? Melissa,
I'm
what
here. My
happened?
wife.
We might have.
Melissa, what
No,
happened
I'm
with the
here.
football game?
I don't know.
Can you hear
I
me
turned
okay?
off my phone. I don't want to see yet. I'll take a look at it when we get done.
Oh boy.
I'm very
Can you guys
nervous.
hear me?
Yes,
Yeah,
we
we
can
can hear
hear
you,
You guys hear me
Kevin.
okay?
Yep.
Okay, yeah, my Wi-Fi went out. My Wi-Fi went out for a second. So I can't see y'all, but hopefully you can hear me.
Oh, Melissa's making funny faces at you.
I'm not making fun.
Well, I deserve it. Well,
If I am, it's
this,
only because of the football game. Oh,
yeah, right.
Kevin, you're
Well,
not going to
if
tell me.
I'm what?
No, Kevin Watts in the chat is putting up the scores. I'm trying not to see them in the chat.
Oh boy. Oh boy, the
It's not.
the Clemson quarterback got injured, taken off in a
Stop,
stretcher.
stop.
Yeah, you can't ever look at your phone when you're behind on the DVR, right? Because the alerts are instant, and especially in this group. Rob made me think a couple things to say. He's right. Like, we're just going to keep lending regardless of what predictions we come up with, and but that's consumer behavior is where it matters, right? When you start talking about borrowers, like when they saw rates shoot up, they were at the absolute lowest in the history of history in February of 22, and they shot up super quick all the way through June of 22. So borrowers freaked out and sat back, and they kind of waited, and rates got worse, and pricing of homes actually went down from June through November, let's call it 10th of 22, when that CPI print showed the first time that it was coming down. So then rates started getting a little better, home prices stabilized, and then of course, in every 12-month period, you could tell your borrowers, like, look, you've been waiting and you missed out on another 5% appreciation or 6% or 7%, depending on your market. Rates have peaked. I think everyone generally agrees that they peaked in October, let's say touching 8%. And so, now the buyer psychology is, man, when there's a spike down in rates, I'm going to jump on it. But there's still seasonal trends, right? So right now, people don't want you trouncing through their house in an open house and a listing. That's why listings are down. And so it's a little harder to find a home. You're online, you're searching, and people really start coming out of the woodworks after next week and the holiday is over. So then spring purchase business picks up. And then somewhere in there, if you get a Fed rate cut, it brings in even more purchase demand plus the little refi boost. And so what's interesting is like, do you coach your borrowers to get ahead of that curve? Like if their lease is up in February, they're in a really good position to go look for a house to buy now, as opposed to renew that lease for another 12 or 18 months on their rental, because then they're going to be behind the game again, right? And so, and then when the Fed, quote, cuts, that's when every consumer that doesn't know anything about anything, isn't talking to an originator to teach them financial literacy. They think, oh, the Fed cut, now rates are going down. Well, too late. Rates have been going down since, October. And so they're behind the 8 ball. And so I'll just, so it doesn't matter what the borrowers think. And I'll say two things I've been saying. We had the soft landing. Soft landing is over, right? Inflation was transitory. It was absolutely transitory. It was a supply chain driven inflation. Yeah, transitory meant 2 years or 3 years, but it wasn't systemic. It was because of supply chain issues. And now that that's largely under control and the Fed has admitted as such, the soft landing is over. And the reason why I say that is because, job openings have started to decrease. Unemployment will get worse from here. Growth will slow down. We're not going to have 4.9% GDP on the backs of exporting oil and food to the world. So it gets harder from here. How hard does the landing get from here? And the worse it gets, the better it is actually for interest rates, which is great for all of us in this business. It just sucks for the broader economy. But we got to get the word out. Like now's the time to jump in the house before the herds start coming in.
Hey, Kevin, what, this is a softball question, but renegotiations, everybody on this call, or I should say every lender on this call, they all have pipelines. Are you seeing a huge uptick in renegotiations, and or have you had to once again dust off the renegotiation policy manual and figure out if it was current? What's the climate like out there in terms of
Yeah.
LOs, wanting to do
Great.
something?
No, great question. And the EPOs is the next one after that. On the rate renos, we do everything case by case. Now, here's one thing. I don't know if everyone does this, but you take our advice. This is what we do. Rates dip down. They shock down in October and November. Let's say I had a loan officer email 7 loan numbers all at once. The secretary goes, I want a rate reno. And we're like, no. Like all 7 of your frickin' bars didn't call at the same time. Like, you know how much money we lose when you do a reno? No, you're denied. Your request has been denied. Now, let's go one by one. Did the borrower actually ask? Is the borrower actually leaving you because your rate is too high? If that's the case, then you come back and we'll work something out. That's how we do. That's how we handle it. So even on our third-party channel, especially with our broker base that is has like a good relationship with us, we're like, hey, dude, come on. Don't just send your whole pipeline and get a better rate. Like, you're locked in. We're about to close. It's a purchase. If they're not going to wiggle, no big deal. In fact, you're making it harder for yourself to get that refinance later, and you're punishing us. And so we literally drill down every single loan, and we work with everyone, and we go through our rate reno, and we try and find a negotiation in middle ground. That's what you got to do. EPOs are next, right? The early payoffs are coming next. It's 6 payments. Everyone says 6 months. It's 6 payments. It's a huge difference between 6 payments and 6 months from the date of funding. It's 6 payments. You got to have 6 payments to the servicer, whoever it is. And for some of us on here who are servicers, it still hurts, even if we're the servicer. And again, we try and tell people, hey, just wait. Rates are going to get even better later. So wait until those last couple rate cuts. You're going to encourage your consumer to take on more closing costs to get a rate that is going to be lower later in the year. Shame on you. So we're constantly working through that as a lender to soften the amount of money that we lose on both those policies.
It's a tough one to navigate always.
Hey, Kevin. Oh, sorry.
Yeah.
Interrupt Melissa, but Kevin, do you ever prompt the LO to say, hey, have your borrower make 2 or 3 payments now? so we can get past this
No.
EPO penalty phase?
No, we have on the sixth payment, just the sixth payment. That's it. But never, and that's if they've already made a fifth. So we don't get out in front of it like that. You know, again, if we're servicing a loan, which we're probably at like, you know, anywhere from 5 to 15% retained any given month, just depending on execution out there. We will try and work with those borrowers a little better. And we don't have a retention team. You know, our retention team is our retail originator or our wholesale originator or a correspondent originator. So we have a little more leeway if we have not sold the whole loan off, but we don't do that.
Yeah. How does that work? Maybe you could explain to the folks who aren't necessarily tuned into the whole hedging world about you have a you have a model that you follow. I don't know if you use a hedging service or not, but you assume uh you know, like you're looking at pull through percentages, you're looking at pricing versus the current market and so forth. And how does a company lose money when a loan officer or a borrower renegotiates the rate down? And do you renegotiate to the current market? So how do you lose money? Why do you lose money? And do you go to current market typically?
Yeah. So thank God, you know, Gary Malice, our partner, my partner at the company, he runs Cap Markets, has a great team. We do have he was on the board of advisors with Rob Kessel, who you're friends with Compass Analytics. And so Compass is our hedge advisory firm. And Phoenix Capital does our MSR, you know, quarterly, I guess, mark for our portfolio. So I guess the easiest way to think of hedging and how you lose or make money, you know, if there's a big move up or down, lenders lose money. That's simple, right? So if you know, and we can just use simple terms. If we do $10 million in locks in a day, we think we have 80% pull through. We'll take out a hedge of $8 million. That's 80% on that day that the loan is locked. And if somewhere in that 30-day period, it doesn't pull through at that lock, the market moves. Well, that hedge you took out, whether the market got better or got worse, this thing's got a different price, this hedge, right? It's either in the money or out of the money, right? And so, you know, it's a no-win situation. So when you were saying earlier, like, it'd be nice if just rates just sat here for 3 or 4 months. Hell yeah, every hedger is saying the same thing. We don't want the volatility, right? So let's just have some nice gains and be able to kind of mark our market in our hedge. But, you know, if you took out this percentage and rates got better, and now you don't have 80% pull through on that 8% set of rates on that $8 million, rates are now at 6%, and everyone wants to relock down to lower rates. There's a pair off fee. I gotta buy to close this position that I didn't fill with a loan and sell off because nobody wanted to stay at that 8% rate. So it's a pair off fee that we consider in the rate renegotiation on a loan by loan basis at that lower rate. That pair off fee is where you lose money. And so, but hey, you got this other loan at a lower rate, which is stickier. So you kind of put a little, you know, maybe you put 25 basis points in there, maybe it's 3/8, you know, depending on how big the move is. As long as the rate's getting better for the borrower, then you go by market rates, current market rates, with a little bit of pad in there to help offset this loss. That pair off fee could be a point. I mean, I could lose the point on that 8% lock that is now a 6% loan that I'm only adding 3/8, right? So I still lost 5/8 before. So, you know, and trust me, we don't have 5/8 margin on the new loan to make up for the loss on the pair off fee. It's just a no-win situation, and that's just how it is. So you live to fight another day. So when you see a market movement of 100 basis points, 125, 150, God bless, 200, that's called a market shock in the hedging world. And yeah, it's just a loser's game for everybody involved, except the borrower.
Certainly brings up the point that I'm often asked by originators around the industry is, gee, if the MBS price has done this or the 10-year rates have done this, why haven't my rate sheets reflected that? And I'll say, when rates are going down, capital markets folks tend to be sticky, in part because of what you just explained so well. So, on the flip side, of course, when rates are going up, yeah, capital markets people are going to match whatever that rate move is higher. But when it's going lower, yeah, it's a little sticky. There's a little hesitation for various reasons. You don't want to get
You,
whipsawed, that's for sure. You don't want the
you bring
volatility.
you bring up a really good point. I mean, everyone on here that's on the origination side, they're all watching Barry Habib on MBS Highway, and they're seeing that, that UMBS, Universal Mortgage Backed Security. We just buy and sell money, right? And I like to say that the secondary market is cold, heartless, and unforgiving. There's 400 basis points of movement in the last 400 basis points on the UMBS. How come there's not 400 basis points in my rate sheet? Well, we had margin compression. And so, everyone now is anticipating even lower rates with Fed cuts. So it's not like you're just going to put 400 basis points in there. And if we sell a loan to an aggregator, right, that they're just going to pay up for it. There's only 6 aggregators really that are major. I mean, I'm not accusing them of collusion, but they all have money too, right? They have profitability they got to work on as well. They can't just give us that 400 basis points because they're locking in a loan at 7% or 6.75 that they know is going to pay off in 4 months at 5.75 or 5.875. So, now that the market's going the other way and rates are getting better, now everyone's like prognosticating that, we'll have high 5% interest rates. Even the MBA put that, by the end of the year. So when loans pay off early, why would someone take that 400 basis points to just move the market, just pay you on day one? You talk about a loss on an EPO fee, and you put it in the pocket of an originator for their commission. You're not getting that back, depending on your clawback and all that kind of stuff. So it's just, we need to find the bottom of rates and then sit there for a while. And I will say it's probably going to be about a year. And in about a year, the Fed should be done cutting. Inflation should be where it's at. We'll have a new or same administration, so there'll be certainty there. And there should be some kind of homeostasis, barring any black swan event in the economy in a year from now. And that is a floor on rates and like kind of this little operating segment of where rates will operate in for the foreseeable future. And you'll see margin come back in because most servicers that like to hold these assets long-term and actually service the loan can probably feel good about having that loan on their books for a longer, stickier period of time. And so I think we still have about another year to see that spread between the 30-year mortgage and the 10-year come down. I'm really watching the 2-year. I want to see the 2-year come down about 130 basis points to get to that, whatever the Fed is going to eventually be. So a lot going on, but I think we got about a year of like, wow, how come there's not more margin in the rate sheets? We got about a year before I think we find a floor, and then servicers go, okay. I don't think they're going to go lower. And so if rates go higher from whenever we have that rate bottom sometime in the next 12 months, those loans stay on the books longer. And so you'll see more margin get into the loans and be less margin compression, less volatility.
Are you, and you guys have a servicing portfolio, correct?
Mm-hmm.
Do you hedge that servicing portfolio?
It doesn't make sense to hedge it unless you are, well, let me say this. We did when it got over 3 billion, right? So like the cost of taking out like the tips and the hedge and all the long-term treasuries to maybe offset the value of the portfolio, it's expensive. There's a cost to take out those positions. So like we all on this call are hedging our lock pipeline, you can hedge your MSR value. Rates going down is going to bring some of those loans, back to the market. I know that some people have made some bets like, hey, if I'm locked at 3% on a 30-year fixed, that loan's going to stay on my books forever. Bullshit. I mean, think of when they locked that loan. Let's call it 3 years ago, okay? Think how much they appreciated equity in the last 3 years. How about after 4 years, a year from now, or even 5 years? They have so much equity that finally they're going to be like, yeah, I'm going from a 3% to a 5.5% rate, but I'm trading 4 or 5 years of equity to buy my next big badass house and the payment's about the same. So at some point, even those 3% loans are going to sell off. And a lot of people are thinking, oh, they'll stay on the books 8, 9, 10, 11, 12 years. I think they're wrong. So to your point, to your question, just being a little detailed with our particular strategy, we had as high as $12 billion in servicing. We sold some of that off. We felt the prices were the best they've been literally since 06. And someone wants to give us 5 years of 100% retention day one in cash, we'll take the cash, right? And then we'll go use that to grow even more. But we didn't do that with our whole book. We still have a good portion of it. And on your Fannie Freddie book, if you've got $3 billion or more, it might make sense to hedge the portfolio, which is a different hedge than hedging the locked pipeline. So it's a really good question you ask. We use Compass as our hedge advisory, and there's some great ones out there. There's so many to name. I mean, MIAX out there. It's just tons of them. So yeah.
So there's
get
no
advisor.
No truth to the rumor, because I actually heard this from a couple of different people who apparently know you. There's no truth to the rumor that whenever you want to buy more clothing, like a new shearling coat, that's when you sell servicing.
Oh,
we're kind of old school over here, so I got to give our CEO Paul Rozo and his co-founder Robert some credit. Gary too. We didn't take PPP money, and we're not saying anything to anyone that did. It was free money. It was all our tax money. We were like, we didn't need the cash. We wouldn't want to take it. And we kind of had that same mindset with selling servicing. It's like if we sell servicing, are we admitting that we needed the cash? And I'm not saying it's a bad thing if you need cash, right? This business is predicated on servicing. I mean, we buy and sell money, and it's all servicing. And so we probably held off longer than a lot of other companies who may have actually needed the cash for that reason. But when you sit there and you look at it, you're like, geez, these prices, I've never seen these prices. Like, if we're ever going to sell some of it, now's the time to do it. And trust me, I didn't get any of it. We didn't get any of it. We left it all in the business. We didn't take any distribution. So it's all just sitting in a Wells Fargo checking account, right? So we're very, very conservative. And to that point, we felt like, as conservative as we are, we don't owe anybody any money. These prices, like to get 100% retention for 5 years, knowing that rates are going to go down, like that seems impossible, right? And so like whatever that portfolio would have been if we held on to it for 5 years, yeah, it was nice making $1.5 million net every month from the portfolio. But after 5 years, if 80% of that portfolio is left, how long does that 80% stick? Does it go another 5, another 7, another 8? Maybe we were dumb to not keep it for 10 or 12 years. But in the next 10 or 12 years, we're going to take the cash we got and we're going to grow and we're going to do more than we've ever done. And that's the plan, at least, that we hope.
more in
One of the
2024.
what's that?
I said more in 2024, and we are way over time, but we are having such fantastic conversations. Okay.
I don't mean to get Kevin wound up again, but I will. My little lead story for Tuesday, I guess at this point, I'm not going to run it tomorrow, but the interesting factoid that I saw this week was that J.P. Morgan, the bank J.P. Morgan, made 20% of all the bank's profits for the year. Okay. Which I think is flipping amazing. So it is it's not only a tough environment for independent mortgage banks this year, but also commercial depository banks as well. And the fact that one bank made, if you take all the income from all the banks and add it up, 20% of that is JP Morgan. It's very interesting, and I'm trying to figure out what implications that might have for lenders. Maybe none, but it certainly shows a great amount of concentration risk from an industry perspective with JP Morgan. So when you talk about profit and loss and making strategic decisions based on profitability, it's been an interesting road this year for banks in general, not only independent mortgage banks. So anyway, and ending with that, Melissa, you're right. We're out of time. So anyway,
We're
take it
we're
away.
over. We had so many fantastic nuggets of information shared, and I didn't want to cut us off from that. Kevin, KP, thank you for joining us. Rob, also
Yes, thank you.
always thank you for joining us. We have a fantastic rundown scheduled for next week with Beth Eller, Reliant Credit Union, joining us. And so we'll see you then. Until then, I hope everybody has a fantastic new year. And I see by Kevin Waltz in the chat that Clemson won by 3. So I'm going to go actually watch the game now and
Clemson
see
won
it
what?
all happen.
Hey,
Wait,
hey,
apparently Clemson
can
won
I
by
just
3, which means I still didn't get the spread. So I got to talk to David Kittle about this.
Hey, by the way, I always enjoy our conversations. I had a conversation with fellow TMC member Mike Metz yesterday at VIP. He is expecting his firstborn in June. He's going to have a baby boy, and if you guys know Mike, this baby's probably going to be like 24 inches. So anyway, thank you guys. Happy New Year. Hope everyone is ready to do more in 24. It's going to be a kick-ass year.
I love it. I love it.
Yeah.
Thank you as always. And congratulations, Mike Metz. Cannot wait to see some pictures. And like we said earlier, I hope everybody has a fantastic new year. We'll see you next week.
Thank you.
Bye, everybody.
Cheers. Thank y'all.